Afternoon and welcome to today's feature of Auditing Uncovered. Today we have our guest speakers from Phar-Mor to discuss the largest accounting scandal of the century and ensure that we perform effective audits. Please welcome our first guest, Ms. Kelly Balfour. Welcome, Kelly. Glad you could join us.
Thanks for having me.
All right, let's get started. Could you give me a brief description of Phar-Mor?
Phar-Mor was founded in 1982. It was a type of drugstore that back then was called a deep discount drugstore.
Oh, tongue twister. Try saying that 5 times fast.
Deep discount drugstores were just stores that offered really low prices, and that's what customers wanted at the time. And Phar-Mor was really good at that industry. By 1992, 10 years after they were founded, they had expanded to 300 stores. But 1992 was also the year that their fraud was discovered.
Well, can you tell us a little bit about the industry and why it became so competitive?
Yeah, in the 70s, because of the recent recession, customers just wanted lower prices, and that's what the demand was. So stores started finding ways to offer lower prices. They had strategies like getting their overhead costs way down and making their own advertising so they didn't have to pay for it, and had strategic purchasing that they did to get low costs. And it was growing really fast. In Phar-Mor's first 5 years in the industry, the amount of stores in the US and Canada almost or more than doubled from 313 stores to 700.
Why was it so important for Phar-Mor to cover up their losses? Was someone benefiting?
Yeah, the president of the company, Michael Monis, who started the company, he was very competitive and he just had to be seen as successful. That was shown by his way he lived his life. He always drove around in a white limousine just day to day. He had a massive wedding. His wife wore a 18-karat gold dress at the wedding. He was always taking out bonuses for himself to go on huge vacations and renovate his home. So he just had to be seen as successful, and that's why he couldn't allow himself to be the president of a failing company.
So I'm sure many of us are curious about hearing about Monis's basketball league. Can you tell us a little bit about it and how it affected Phar-Mor?
Yes, Monis always wanted to play professional basketball, but he was just too short. So once he started making money, he kind of fulfilled that dream by starting the World Basketball League, which only allowed players that were 6'5" or below to play in the league.
Sounds like a case of little man syndrome.
Yeah, well, he was only 5'9", so he didn't even qualify to play on his own team. But that may have actually played into the fraud as well, because nobody wanted to watch short basketball players, it turned out, and the games had a $13,000 loss on average per game. So that was even more reason he needed to make more money and support his league and be seen as successful in both of those ventures he had taken on.
Thank you so much, Kelly, and for the valuable effort. Up next, we have Mr. Alex Winchell talking about manipulating financial statements. Welcome.
Good to be here, Katrina.
Hello.
Thank you.
Nice to meet you. Phar-Mor has significantly misstated their financial statements over a 10-year period, which is a pretty large amount of time. What would you say is the most significant aspect that was misstated?
Well, I would have to say inventory was definitely the most misstated item on Phar-Mor's financial statements. It played a central role in the fraud, and they really used it to disguise the massive losses they were incurring.
So how did they go about hiding all that inventory?
Well, as year-end approached, Phar-Mor and its executives, like Mickey Monis, realized that they were in for some serious losses. So they devised a plan to distribute the losses among 129 of Phar-Mor of the chain's locations, and they did this by creating fictitious expenses on each individual store's balance or on their income statement. Sorry, and to offset those expenses, they needed an asset, and in Phar-Mor's case, they usually added inventory to the locations. But to get by auditors, they also had to have some correct entries on the books, and they would issue fake vendor invoices and make fake accounts payable. So then when they did reduce those fake payables, it was never actually a decrease in the company's cash.
Great, let's go take a look at the journal entries. Alex, could you explain these entries over here?
I sure can. So Phar-Mor used the periodic method when accounting for inventory. And at year end, their entries to overstate inventory would likely have been a debit to purchases. And in their case, they failed to record a liability, so I assume that it would just be no entry on the credit side. The correct entry for inventory purchases under the periodic method is a debit to purchases and a credit to accounts payable.
Why were Phar-Mor's actual margins lower than budgeted?
Well, due to power buying, Phar-Mor had a lot of difficulty allocating costs to their inventory. With power buying, suppliers grouped different types of goods together and charged one lump sum for them. They did not allocate, or they did not post prices for each specific good. When the goods were received by Phar-Mor, they had an original plan to mark everything up 20%, and then they would sell it at that price. But that strategy was too in line with competitors such as Walmart and Walgreens. And they decided, well, Mickey Monis did with his desire to not be undersold by Walmart, decided to lower margins on these certain price-sensitive goods that they were getting. The company would then prepare budgeted gross margin reports to determine what their cost of inventory was. But to do this, they had to take samples of their inventory. And when they did that, they took samples of a few price-sensitive goods and a few normal goods. This kind of lopsided what those margins look like, or what those reports look like. When auditors checked their reports and did their own calculations, they did much the same procedure. But it turns out that those price-sensitive items made up a relatively large percentage of Phar-Mor's net sales. So to be more accurate, the auditors and Phar-Mor should have applied a weighted average method to determining their cost of inventory, since they were not given historical prices by the budgeted gross profit or gross margin reports that were reviewed by the auditors and investors.
So, how did they inflate their earnings?
Well, it's pretty simple. Basically, they would take their overstated inventory and would record a regular sales transaction. The only difference was that they did not make the debit to cost of goods sold. They used a fraud holding account, and at the end of the year, they would, to avoid auditor suspicion, they would zero that account out and debit inventory again, or purchases, using the periodic method. But anyway, it was just a really big circle revolving around inventory the whole time.
What did Phar-Mor do to cover up the fact that their actual margins were so low?
So naturally, Mickey Monis and other key Phar-Mor executives did not want shareholders, or auditors for that matter, to know that they were selling goods below cost. Basically, what Monis did was authorize the accountant to manipulate or modify the budgeted gross profit or gross margin reports that were reviewed by the auditors and investors.
So, how did they inflate their earnings?
Well, it's pretty simple. Basically, they would take their overstated inventory and would record a regular sales transaction. The only difference was that they did not make the debit to cost of goods sold. They used a fraud holding account, and at the end of the year, they would, to avoid auditor suspicion, they would zero that account out and debit inventory again, or purchases, using the periodic method. But anyway, it was just a really big circle revolving around inventory the whole time.
Tell us about these entries.
Yes, so when the company decided to inflate earnings, obviously the first half of the entry would have been debit to cash and a credit to sales revenue. But here's where it went a little awry. The company decided to debit a fraud holding account instead of the normal cost of goods sold. So here's what Phar-Mor did, and here is the correct entry. At year end, to zero out the fraud holding account to avoid suspicion by auditors, they basically did a reversing entry and debited inventory and credited fraud holding.
Describe how Monis contributed to the basketball league.
Well, Monis owned roughly 60% of each team and contributed $15 million
what were the effects of the contributions on Phar-Mor's income?
Well, since Monas decided to expense the contributions on the company's books, they made their way onto the income statement naturally. This decreased Phar-Mor's taxable income, reduced the amount of federal taxes they had to pay.
And what should they have done instead?
Phar-Mor should have, well, Monas in particular, should have consulted with shareholders before contributing to the league, and if they had declined to allow it, he should have used his own personal resources.
Thank you, Alex, for joining us tonight.
Thank you.
Up next, we will be discussing how the auditors could have caught the financial statement frauds, what they did wrong, and what procedures the auditors should have followed. Let's welcome our next guest, Ms. Kristen Motes. We're thrilled to have you here this afternoon. First off, what is one thing the auditors could have done differently?
They should have practiced professional skepticism. And how they should have done this is by questioning management and employees of what the company thought was suspicious and may indicate fraud. And so another thing they could have done is trusting Finn to make the entries in the books that had an existing relationship with the company. And
Who is Finn?
He's the CFO of the company. And this violates the past experience criteria of the AICPA standard 240. And so that results in no professional skepticism.
And were the auditors independent?
No. Before accepting the audit of Phar-Mor, the auditors should have taken the time to determine whether they were truly independent of the client. The amount of time that Finn worked at the Coopers and Lybrand was not documented. This indicates a bias of the audit firm, which violates the Code of Professional Conduct, Objectivity and Independence section.
If they would have taken Professor Woodland's class, they would have known this. So, did Phar-Mor assess the management's integrity?
No, they did not. Monas had a bad reputation with the vendors. If the auditors had questioned the vendors and related parties, they would have discovered it. They also should have questioned many employees because they were aware of the fraud and nervous about it. So they would have uncovered it a lot sooner.
Inventory was identified as a high-risk area by the auditors. Is it true that many aspects of inventory were overlooked in the audit?
Yes. A huge mistake that the auditors made was telling Phar-Mor which stores they were going to do the physical inventory counts observation. So since inventory was identified as the high-risk area, they should have followed standard 240, and they should have observed inventory counts at certain locations on an unannounced basis.
What did Phar-Mor do when they found out what stores the auditors would be observing?
They moved the inventory around to different stores to make it look like the correct amount of inventory was at the store.
Let's take a look to see what they did. And then,
Shoot it.
Quick! The auditors are coming! Let's go!
Stack it up. There's nothing in it. Just put it in there. Let's go. We're supposed to have 4 million units here, guys. Hurry up.
we're ready for the auditors. How many stores did the auditors do a physical inventory observation for?
4 stores out of 300.
Wow, that's only 1% of the stores. Doesn't seem like a very representative sample. What else could the auditors have done?
Also, by following standard 240, they should have scanned general ledger and journal entries at year end for unreasonable and odd account names and titles.
Wow, 240 seems like a very important standard. Monas was all about being an athlete and funded his league with Phar-Mor's revenues. What could the auditors have done to detect that fraud was occurring?
They should have examined written checks. They would have seen checks being issued to an organization that Monas owns 60% of. Auditors should have traced expenses in the general ledger back to backup documents. There would not be any backup documents for these expenses because they were checks being written for the basketball league. This audit standard 240 states that additional audit procedures should be performed when management override of controls is a risk, which it was in this situation.
So, how was Phar-Mor's relationship with vendors?
They are not paying vendors, and that affects accounts payable. And so they should have sent accounts payable confirmations. And if there is a timing difference or discrepancy, they need to expand the procedures to include the cash disbursements journal. And in Standard 505 states examining the cash disbursements journal is a good additional procedure to perform along with the confirmations.
Such a simple thing could have raised a red flag to the auditors. Thank you for joining us on Auditors Uncovered Phar-Mor Edition. We will close with some never-before-seen footage of Coopers and Lybrand in action. Thank you and have a great night.